Why does Japan own more than $1 trillion of America's debt? And what happens to your wallet, your mortgage, your car loan, even your credit card rate, if Japan suddenly decides to sell that debt? Believe it or not, a country smaller than California, Texas, and Florida combined quietly lends more money to Washington than any other nation on Earth. Today we're breaking down how Japan got here, why it keeps buying America's IOUs, and what it would mean for every American if Japan starts cashing out. How big is Japan's share? America's national debt has crossed $38 trillion. That's a number with 12 zeros. About 3/4 of it, or $28 trillion, is held by the public. Foreign investors together hold roughly $9.1 trillion, about a third of all tradable U.S. debt. And Japan alone owns $1.18 trillion, around 3% of all U.S. government debt, and nearly 1/9 of all foreign-held debt. So if Washington borrows $100, roughly $3 of that comes directly from Japan. Think about that. A single country lending 3 out of every 100 borrowed U.S. dollars. That may not sound like much until you realize the scale. Japan's stake is bigger than China's, bigger than the UK's, and bigger than any other foreign lender. It's the largest single foreign source keeping America's borrowing machine running. But why would Japan keep pouring its savings into American debt instead of using that money at home? Why Japan buys U.S. debt? It starts with trade. Every time Americans buy a Toyota, a Sony TV, or a Nintendo Switch, dollars flow from the U.S. to Japan. In 2023, Japan exported $147 billion in goods to the U.S., but imported only $76 billion, a $71 billion trade surplus. In 2024, the story barely changed. $148 billion out, $79 billion in, another $69 billion surplus. Those extra dollars pile up fast. Instead of letting them sit idle, Japan invests them in U.S. Treasury bonds, the safest, most liquid asset on the planet. For Japan, Treasuries take all the boxes. They're backed by the U.S. government, virtually zero default risk. They can be bought or sold any time in massive volumes. And most importantly, they pay far more interest than Japanese bonds. Right now, a 10-year U.S. Treasury pays about 4.5%, while Japan's own 10-year bond pays around 1%. That gap means massive income differences for Japan. With about $1.18 trillion invested in U.S. Treasuries, Japan earns roughly $53 billion a year in interest. If that same money were parked in Japan's own government bonds, it would earn only around $11 billion. That's a difference of over $40 billion every single year, just from higher U.S. yields. For Japanese banks and pension funds, that's a no-brainer. America's debt is not just safe, it's profitable. But how did Japan's holdings balloon to this level over time? Japan's investment story stretches back decades. Early 2000s, under $800 billion in treasuries, built up from its export boom. 2008, the global financial crisis hits, investors panic, and Japan's holdings surge to $1.2 trillion as everyone seeks safety. 2012 to 2016, U.S. rates stay higher than Japan's near-zero yields, so Japan keeps buying, around $1.1 trillion on average. 2020 to 2021, during the pandemic, global investors rush back into U.S. bonds. Japan's total peaks near $1.29 trillion. 2022 to 2024, the yen weakens sharply, forcing Japan to sell some treasuries. Holdings dip to $1.07 trillion. Late 2025, as markets calm, Japan creeps back up to $1.19 trillion. Every crisis in the world seems to push Japan, and everyone else, back toward the US dollar. Because when things get rough, safety wins. But what exactly caused Japan to start selling during those weaker yen years? The yen problem. Japan's debt strategy is deeply tied to its currency, the yen. In 2021, 1 US dollar bought about 110 yen. By late 2022, it took 150 yen. By 2024, nearly 160 yen, the weakest level in 34 years, a 36% drop. That kind of currency crash hits ordinary Japanese people hard. Imported energy, food, and raw materials suddenly cost far more. A weaker yen helps exporters, sure, but it punishes everyone else at home. So Japan's government stepped in. In April 2024, it spent 9.8 trillion yen, $63 billion, buying yen, boosting its value by about 5% in one day. Then, in July 2024, it spent another 5.5 trillion yen, $37 billion, to slow the fall again. Where did all that cash come from? Japan raised dollars by selling some of its U.S. Treasury bonds. Here's the chain reaction. 1. Sell U.S. bonds, get U.S. dollars. 2. Use those dollars, buy yen, make the yen stronger. Every time Japan defends its currency, it quietly sells a small slice of America's debt, which can push U.S. interest rates slightly higher. So what if Japan decided to sell a lot more? Not billions, but hundreds of billions. What happens if Japan sells U.S. debt? Economists estimate that for every $100 billion in foreign bond sales, U.S. Treasury yields rise about 0.4 to 0.6 percentage points. If Japan sold 20% of its holdings, roughly $236 billion, yields could jump around 1 point. If it sold 40%, nearly $472 billion, yields might climb 2 points. That shift would ripple straight through American life. Mortgages, currently about 6.2%, could jump to 7 or 8%, roughly $260 more per month on a $400,000 loan. Credit cards, averaging 21%, could edge up to 23%. Car loans, around 7.7%, could pass 8.2%. And when borrowing costs rise, the stock market usually stumbles. Home builders, real estate trusts, and utilities all could drop 5 to 10% as money moves out of stocks and into those higher yield bonds. But what about the dollar itself? How would Japan's move shake the value of U.S. money? How it affects the dollar and inflation. When Japan sells treasuries to buy yen, the U.S. dollar weakens, just like it did after the 2024 interventions. A weaker dollar makes imported goods like oil, food, and electronics more expensive for Americans. That means slightly higher inflation, not catastrophic, but enough to raise prices at gas stations, grocery stores, and online checkouts. You might not link a Tokyo currency trade to your grocery bill, but it's all connected. When a global player like Japan adjusts its portfolio, the effects echo through every part of the world's largest economy, ours. So if it's risky and complicated, why doesn't Japan just stop buying U.S. debt altogether? Why Japan still keeps buying? 3 reasons keep Japan in the game. 1. Safety. U.S. Treasuries remain the most trusted asset on Earth. 2. Profit. Japan's 10-year bond pays barely 1%. America's pays about 4.5%. That's a massive gap, and it brings in over $40 billion in extra interest income each year. 3. Stability. Holding U.S. debt helps prevent the yen from strengthening too much, which protects Japan's export-driven economy. So even though Japan occasionally sells to stabilize its currency, its long-term strategy still points one way, toward Washington's bonds. Which leads to the final question. What does this trillion-dollar relationship really mean for both nations? The trillion-dollar connection. Japan might hold only 3% of America's total debt, but that's more than 10% of all foreign loans, concentrated in one country. If Japan keeps buying, the U.S. can borrow cheaply and keep interest rates lower. If Japan sells too fast, rates rise, the dollar shakes, and American families feel it through higher loan payments and higher prices. Japan's savings help fund America's spending, and America's stability protects Japan's wealth. That's the trillion-dollar connection, quietly holding two of the world's largest economies together.